Imagine having a cool $10,000 in your pocket to invest. How would the Oracle of Omaha, Warren Buffett, put that money to work this year? As we delve into the mind of this financial titan, we'll introduce you to his unique investment strategy, a method that has propelled him to staggering heights of success. Born in Omaha, Nebraska, Buffett has become synonymous with value investing, a strategy that focuses on businesses with solid fundamentals that are undervalued by the market. He's not just a speculator, he's a patient investor who understands that great profits come to those who wait. The importance of understanding this strategy cannot be overstated. It's not just about picking stocks. It's about picking the right stocks at the right time and holding on to them. Warren Buffett didn't become one of the richest people in the world by accident. His investment strategy is a proven path to wealth. Now let's see how to apply it to a $10,000 investment. Warren Buffett's investment principles are simple yet profoundly effective. They are the foundation of his investment strategy. While they may seem straightforward, their implementation requires a keen sense of judgment and an understanding of the market. So, let's dive in and explore these principles. The first principle is value investing. This is the art of buying stocks at less than their intrinsic value. The intrinsic value of a company is determined by its fundamentals, such as its earnings, dividends, and sales. Buffett doesn't just look at a company's stock price, he delves into the nitty-gritty of a company's financials, understanding its strengths and weaknesses, its market position, and its future prospects. He believes in buying a dollar's worth of value for 50 cents. It's about finding hidden gems in the market, companies that are undervalued by others, but have strong fundamentals. The second principle is the buy and hold strategy. Buffett is a long-term investor. He doesn't buy a stock intending to sell it in a few months or even a few years. He buys stocks of companies he believes in and holds on to them for decades. This strategy requires patience and conviction. It's not about timing the market, but rather about time in the market. Buffett once said, "Our favorite holding period is forever." These principles go hand in hand. Value investing identifies the right companies to invest in, and the buy and hold strategy allows the investment to grow over time. Perhaps the most important thing about these principles is that they require thorough research and understanding of the company before investing. Buffett spends a lot of time studying companies, reading their annual reports, understanding their business models, and assessing their management teams. By understanding and applying these principles, you can make wise investment decisions, just like Warren Buffett. Remember, investing isn't about making quick money. It's about making wise decisions that will pay off in the long run. So take your time, do your research, and invest in value. That's the Warren Buffett way. Now, let's put these principles into action. How can you apply Buffett's investment strategy to a $10,000 investment this year? First, you need to understand the concept of value investing. It's like shopping for bargains in the stock market. You're looking for companies whose stock prices are less than their intrinsic value. The intrinsic value of a company is its true value, which may not always be reflected in its current stock price. When a company's stock price is less than its intrinsic value, it's said to be undervalued. So, how do you find these undervalued companies? There are a few things you can look at. One indicator is the price-to-earnings ratio, or PE ratio. This is the price of a share of stock divided by the earnings per share. A low PE ratio could indicate that a company is undervalued, but remember, a low PE ratio doesn't always mean a company is a good investment, it's just one piece of the puzzle. Another thing you can look at is the company's book value. This is the value of a company's assets minus its liabilities. If a company's stock price is less than its book value, it could be undervalued. But perhaps the most important thing to look at is the company's earnings. Are they growing? Are they consistent? A company with growing, consistent earnings is likely to be a good long-term investment. Let's say you've done your homework and found a few companies that appear to be undervalued. Now what? This is where the buy and hold strategy comes into play. Once you've invested in a company, you hold on to those stocks for the long term. You're not looking to make a quick buck, you're looking to build wealth over time. Why? Because the stock market tends to increase in value over the long term, despite its short-term ups and downs. By holding on to your investments for the long term, you give them a chance to grow. And if you've chosen well, those undervalued companies you invested in will eventually reach their true value, and your investment will grow. But remember, investing is never a sure thing. It's possible that a company you invest in will not perform as well as you hope. That's why it's important to diversify your investments and not put all your eggs in one basket. So there you have it. By identifying undervalued companies and holding on to your investments for the long term, you're applying the principles of Warren Buffett's investment strategy. And who knows, maybe one day you'll be just as successful as he is. By carefully selecting undervalued companies and holding on to these investments for the long term, you can maximize your returns, just like Warren Buffett. Warren Buffett doesn't put all his eggs in one basket. The importance of diversification in his strategy cannot be overstated. Diversification, in essence, is a risk management strategy, and it's one that Warren Buffett has used to great effect. He understands that not all investments will succeed all of the time, so he spreads his investments across a variety of different sectors and industries. This way, if one sector takes a hit, the others can pick up the slack. So how does this apply to a $10,000 investment? Well, let's think about it. If you invest all your money in one company and that company fails, you lose everything. But if you spread that money across several different companies in different sectors, you're much less likely to lose it all. Of course, the potential for gains can be less dramatic, but the risk of loss is also significantly reduced. Let's delve a bit deeper into Buffett's approach. He doesn't just diversify for the sake of diversification. He's not buying stocks at random. Instead, he carefully selects companies that he believes have strong fundamentals and a solid future. He diversifies within these carefully chosen sectors, spreading his investments across a variety of companies. This is a strategy that you can emulate with your $10,000. Don't just throw your money at the stock market and hope for the best. Do your research, understand the companies you're investing in, and then spread your money across those companies. It's a strategy that requires patience, but it's one that can pay off in the long run. Keep in mind, however, that diversification is not a guarantee against loss. It's a tool to help manage risk, not eliminate it. But by spreading your investments across a variety of sectors and companies, you're less likely to be hit hard by a single market downturn. By diversifying your investment, you can spread the risk and increase the potential for returns. One of the secrets to Warren Buffett's success is his understanding of the power of compound interest. Let's imagine compound interest as a snowball. Picture yourself at the top of a snow-laden hill and you roll a small ball of snow down. As it travels, it picks up more snow, gradually growing larger and faster the further it descends. This is essentially how compound interest works. When you invest your money, you earn interest on your initial amount, your principal. But here's where the magic happens. Instead of taking that interest out, if you leave it in your investment, you start earning interest not just on your original principal, but also on the interest you've accumulated. Over time, this creates a snowball effect, allowing your investment to grow exponentially. This is a fundamental principle that Buffett has long leveraged to his advantage. He's known for his buy and hold strategy, where he invests in companies for the long term, often decades. By doing so, he allows his investments to compound over the years, multiplying his returns. Buffett's first investment was in a farm when he was just 14. He didn't sell it after a year or even 5. Instead, he held on to it, letting the earnings compound, which eventually led to substantial returns. This early experience shaped his investment philosophy and underscored the power of compound interest. But remember, compound interest is a long game. The real benefits start to show after a considerable amount of time. The longer your money is invested, the more time it has to compound, and the larger your snowball becomes. That's why Buffett's strategy focuses on long-term investments. But this isn't just for the Buffetts of the world. Everyone can harness the power of compound interest. Whether you're investing $100 or $10,000, the principle remains the same. It's about patience, consistency, and time. By understanding and leveraging the power of compound interest, you can significantly increase your investment returns, just like Warren Buffett.